Welcome to Deloitte's Debrief Test webcast series in Asia Pacific. Our webcast today is from our Corporate Income Test and Fourth Place series, as it is titled MMA and COVID-19 Strategy in China, Hong Kong, and Taiwan, Charting New Horizon in a World of Asymmetric Recovery. My name is Shelley Liao, and I'm a tax partner based in Deloitte Taiwan, Taipei office. I'm your host today. I have three speakers with me today: Stanley Law, Simon Tan, and Ken Poon. Stanley is an AP E2E MMA leader based in Deloitte China, Hong Kong office. Simon is a tax partner based in Deloitte China, Shanghai office, and Ken is a tax partner based in Deloitte China, Shenzhen office. You may access our bio on the left side of the screen. Before I introduce the agenda for today's webcast, I would like to take a moment to highlight some of the features of our webcast console. First, our users are on listen-only mode. If you have any content-related question, you can submit at any time in the Q&A box at the bottom right of the screen. We'll do our best to respond to your question during the presentation. Second, all PC users can maximize or minimize each box at your convenience during the webcast. You may also explore the icon at the bottom of the screen. If you want to download today's slide and related publication, please go to the download and link box. On the other hand, mobile device users can view the slide and answer the survey on screen. Lastly, if you require an attendance record for this event, you can download your CP certificate by clicking the Request CP icon at the bottom of the webcast console. Now, let me give you an overview of the topic that we will discuss. First of all, we will hear from Stanley about the recent MMA trend in Asia Pacific, as well as the impact from the global COVID-19 pandemic. We will then discuss MMA strategy from tax perspective in China, Hong Kong, and finally in Taiwan. Following the question, we will have a few minutes for question and answer. As usual, we will try to address our guest questions during this presentation. If you do not have enough time, then we will do so after the webcast. 2020 has been a trying year. So Stanley, can I ask you to give us your view on the economic outlook and MMA trend in this region? Stanley?
Thank you, Shelley. Hi, everyone. Thank you for having me here today. I would like to use the next 10 minutes or so to share with you some of the things that we are seeing in the M&A market now. And hopefully we'll hear from you in the questions as well on what you're seeing and what you care about. Okay, as Shelley mentioned, I think everyone experienced a very different 2020. In the post-COVID world, like many other things, we are seeing that M&A is being redefined as well. But we are seeing an asymmetric recovery across regions and sectors. These far-reaching implications of COVID-19 are likely to result in a new normal across many sectors, and we're seeing many using M&A to accelerate the transformation. I probably will understand that the rebound curve will help companies decide the direction of their strategy, identify new capabilities required, and prioritize markets where they need to operate to drive recovery, growth, and profitability. Redefining M&A in terms of these scenarios and the choices will bring much needed clarity of purpose while confronting uncertainties. A combination of what we're saying, defensive and offensive M&A strategies will emerge as companies strive to safeguard existing markets, accelerate recovery, and position themselves to capture market leadership. But with this backdrop, we are also seeing post-COVID deal-making will be materially different, with a corporate purpose that intertwines sustainability with commercial success and building trust in the community. But we're seeing the cornerstones of deal-making changing. Like there's some of the key factors what probably we can touch on from like virtual relationship. The relationship with people is very different now. Like you're looking at the workforce, organization has to adjust to work remotely. Looking at the business model, the way of serving customers and delivery service now requires new model adaptation, like telehealth, for example. Like from a consumer perspective, there are new sources of demand virtually. There's shifting in channel preferences to online. There are also shifting perception of value and perhaps higher price sensitivity because of the economic impact that everyone is facing nowadays. If you're looking at diligence, we probably got to broaden due diligence to assess a degree of structural disruption to the target company's industry and the target's business model and competitive edge. I think one of the words that you probably hear most about is digitalization. The acceleration of digitalization in this post-COVID world is probably one of the most important considerations in looking at a deal. Like this crisis has demonstrated the attraction of new digital channels in safeguarding the future. Social distancing is driving social experience, and bolt-on acquisition on technology assets is so important. Looking at leadership, like this is a big test to a lot of the management teams, whether they could come up with creative approaches to adopt new business models and pricing models in a timely manner. Operating model improvement is critical to ensure business continuity, and cost reduction probably not the only thing, but how to enhance or sustain productivity is also critical. Next page, please. So looking at the post-COVID world, like Deloitte has created a few scenarios from our perspective, and we're seeing that like under different scenarios, it will like imply different ways or a level of disruptions in different industries. So this scenario has been developed based on two key uncertainties. It's the severity of the pandemic and the level of collaboration to combat the crisis from a country-to-country perspective. So, number one, the passing storm. Like we are assuming drastic short-term financial and economic shocks with quicker recovery to lifestyle, but moderate long-term economic impact. I think that's what probably a lot of the audience here is seeing. Good company trust in the political landscape declines, and large corporations, particularly the tech giants, step up to fill the void. Number three, sunrise in the east, waves of pandemic causing a global power shift as China and other Asian nations rise in the economic and political prominence. I think that's something that we can probably will go through later on in my presentation. Lone wolf. We're talking about increased isolation policies with a lasting implications on international political and economic relationships. So each scenario, as I said, will impact and disrupt the ecosystem across industries and requires a different strategic approach. So I think the key is to look at this: how will these business drivers impact you and your industry? Next page, please. So going back to Asia. So as I said, there's strong evidence that sunrise in the east is happening. We're clearly seeing Asia Pacific has a strong deal flow, and then there's a lot of activities from the large private equity players as well. So a lot of deals are happening in this area. So we are seeing a lot of different type of transactions where we brought in kind of categorized into offensive and defensive strategies. If you look at defensive, meaning that deals that use to salvage value, meaning raising capital by divesting non-core assets or maintain competitive advantage by being more like trimming down and being more competitive. And you can see that like there are like a few examples from like Metro disposal to Walmart, like Sunart, Alibaba's acquisition of Sunart. I mean, these two are more on the retail, the kind of the new retail model, how we use technology and how to create from traditional offline channel into online. And then like Baidu's acquisition of Joy. I mean, this is a good way of looking at it is the importance of social media and the mobile space where Baidu is catching up on. So if you look at offensive M&A, we're talking about how to transform the business to capture like additional revenue and adjacencies and changing the game to define new world order through alliances and JVs. I think, like some of the deals that you're seeing could include like Tencent investing into Universal Music is a big transaction, entering into a global platform from a content perspective. Tencent also driving the merger of Huya and Douyu, redefining the live streaming platforms, and then also Sony's investment in Bilibili in China, going into a new market. I think that's all a very what we see offensive type M&A strategies. Next page, please. So we're looking at more numbers. This clearly has been the busiest summer ever, which is unexpected by many. Like since June, there has been approximately $100 billion plus negative news announced globally. So this is really a big rebound. I think if you look at Asia, Japan has been a key driver of those negatives and continue to be active with particularly with the Japanese trading houses. From a cross-border transaction perspective, I think Japan, China, Korea is also emerging. Like will be continue to be active. Yeah, also like certain emerging trends that behind these big deals. Like we're seeing one of it is the abundance of private equity. I mean, private equity dry powder is at its all-time high. And we expect to see a lot more big private equity transactions in the near future. I think there's also a refocus on core businesses. So we will probably see a lot more divestitures of non-core assets and carve-out to continue. That not only for MNCs, but I think generally we will see more of that as we go through this post-COVID time. Next page, please. I'm seeing my time is about up, so I think I will conclude my presentation here with some lead-aways. I think if anyone is interested to read more into our point of view in terms of M&A and how to charter these new horizons, like we have certain publications that you could get online, or if you can't find it, like do reach out to us directly, and then we're happy to share that with you. Okay, I'll pass the time back to Charlie. Thanks a lot.
Okay, Stanley. And then bring us to the first polling question of the day. The question is, what is the likelihood that your organization will participate in M&A activity for the next 6 to 12 months? And you have option, very likely, somewhat likely, neutral, unlikely, or do not know, and not applicable. So audience, can you make your choice now? Okay, while we are waiting for the result to come in, Stanley, I have a question. You mentioned that we will have a new normal, since you serve so many clients, do you have any insight of the M&A pivot in Asia Pacific other than you just mentioned?
Okay, thanks, Shelley. I think, as I probably shared before, I'm very bullish. I'm seeing a lot of activities and then talking to a lot of clients and understanding the activity level is strong. I think there are a few reasons from both offensive and defensive. I may use this phrase, meaning that what we're seeing is that there are a lot of distressed market opportunities, particularly it's not only in Asia, but I think Asia in general, probably Greater China, we're seen as a great source of capital, and then a lot of the assets will become available within our region and also beyond. Just with this, a lot of the government relief programs may come to an end, and a lot of companies will come to a point where, as I said, they need to focus on the core. They go to divest, or they just need capital to keep them afloat. So there are a lot of opportunities in this distressed market that they can focus on. And then also, I think the drive for transformation is larger than ever. So I guess a lot of companies will take this opportunity to just accelerate the transformation through M&A. So that's what I see. Thank you, Shelley.
Okay, I see. Okay, now we have the number. As you can see on the screen, we have very likely 18.8%, somewhat likely 22 something, neutral 20, unlikely 22%. So I guess it seems to me that audience did see some light in the tunnel, but want to see more positive signs before move forward. Okay. Then now let's turn to Simon for his input on typical Chinese tax issue for carve-outs. Simon.
Thank you, Cherry. For China, we have also seen multinational groups carrying out global or regional level business unit carve-out with significant restructuring required in China. The restructuring steps are often driven by commercial and regulatory considerations, while the Chinese tax implications that may arise from those restructuring steps should be carefully considered before finalizing the restructuring plan. In today's webcast, we will give you an example to illustrate the key Chinese tax issue for carve-out restructuring involving China. If we look at the structure chart on the left-hand side, Group XYZ is a group with global footprint. The ultimate parent of the group owns subsidiaries around the world, including China. Let's say the group operates two business units, A and B. Both business units operate in multiple jurisdictions. Group XYZ contemplate carving out business unit B to a separate structure, i.e. the diverse holdco structure, to be invested by a third-party investor. The ultimate parent of the group owns a Chinese company through a non-Chinese holdco. We can call the Chinese company as a mixed entity because it houses both business units A and B. In our example, business unit B needs to be transferred under the diverse holdco structure. In China, except for a very few industries, foreign companies generally do not have an option to operate through a branch structure. So in the diagram, we put a China diverse code as a placeholder to house business unit B to be carved out from the mixed entity. Next slide, please. In order to carve out business unit B from the mixed entity, there could have been many different ways. One of the most natural ways of restructuring is for the diverse holdco to set up a diverse code in China to acquire business unit B from the mixed entity. This is described as option A on the slide. However, the carve-out of a business unit would usually have significant impact on the operations. If in the mixed entity, business unit B has a much larger size comparing with business unit A, it may be more efficient and cost-effective to move out business unit A from the mixed entity and to transfer the mixed entity equity interest to diverse holdco. There are different ways to move out business unit A, including under option 2, the mixed entity to transfer business unit A to an existing or new Chinese company in Group XYZ, or under option 3, the mixed entity to split business unit A to a new co owned by holdco. There may be other commercial or regulatory reasons where option 2 and 3 need to be considered. For example, business unit B may be a regulated business which requires certain licenses obtained by the mixed entity, and it could cause operational discontinuity if business unit B has to start in a newly incorporated company. Another example is that when bidding for business opportunity in certain industry, a company with long business history and credential in similar projects may be highly preferred. These 3 options are just sample options, and they are apparently other restructuring steps that can achieve the same or similar end result. Also, in the real world cases, there could be multiple Chinese companies being mixed entity whereby more options of the restructuring may need to be considered and evaluated. In the next few slides, we will illustrate at a very high level the key Chinese tax issue in relation to the 3 sample restructuring options. Next slide, please. Let's look at option 1 first. As mentioned in option 1, divest holdco needs to fund divest co to acquire business unit B from the mixed entity. The location or tax residency of divest holdco or the relevant foreign holding structure may result in different withholding tax rate on future dividend repatriations. The funding will usually be provided with a mix of equity and shareholder loan. Both Chinese foreign exchange control regulation and Chinese tax implications should be considered to determine the debt and equity mix. From the mixed entity perspective, one of the key issues is to determine the value of business unit B to be transferred to divest co. From a commercial and legal perspective, the transfer could be done at fair market value or book value. However, from a tax perspective, technically the transaction should be done at fair market value. Therefore, if the transfer is done at book value, the company would need to carefully assess the associated Chinese tax risk from both technical and practical standpoints. There are multiple types of taxes that may arise from the transfer. From an enterprise income tax perspective, any gain derived from the transfer will be included in the taxable income of the mixed entity and generally subject to 25% tax rate or the applicable EIT rate for the mixed entity. Certain EIT incentives require that company's taxable revenue to meet certain tests. Therefore, the company needs to be mindful if such a transaction would negatively impact the eligibility of existing tax incentive of the mixed entity. From a VAT standpoint, the Chinese VAT regulation provides that if the assets are transferred together with associated liabilities and workforces, the transfer is considered as out of scope for VAT purposes. Therefore, such rule will only specifically cover tangible asset, immovable asset, and land use rights. It is unclear whether intangible asset and goodwill are covered. The interpretation of such rule therefore varies from local practices. There will also be transaction taxes such as stamp duty, the rates of which vary from the types of the asset to be transferred. If the transfer of the real estate property is involved, there could be very well significant transaction taxes. For example, the land value appreciation tax, or briefly we call it LVAT, may apply on the gain with up to 60% progressive tax rates. From divest co perspective, it is important to determine the tax basis that can be EIT deductible or amortizable. Goodwill is not tax amortizable and cannot be deducted for EIT purposes until the business unit is subsequently sold again by divest co. It is possible to amortize identifiable intangible which were not on the book of the mixed entity, but they require some valuation, accounting, and tax efforts required to support such tax amortization claim. In case the transfer is subject to VAT, with proper VAT invoices issued by the mixed entity, we call it file payout in China, divest co can generally use the VAT as input VAT credit to offset against its output VAT, assuming it is the general VAT taxpayer in China. Divest co may also be subject to transaction taxes such as stamp duty, which is range 3 to 5% tax as well, may be payable by the buyer for acquiring the real estate properties. Next slide, please. Now we can take a look at option 2. As we mentioned earlier, there are many different commercial reasons that may require business unit B to stay with the mixed entity. In addition, if business unit B happens to involve real estate, while business unit A does not, transferring business unit B directly may be less preferred because it may result in significant transaction taxes, such as the LVAT, as I mentioned. There may be a showstopper to the carve-out restructuring. In option 2, the mixed entity will sell business unit A to another entity within group XYZ. It could be a new Chinese entity or an existing one in the group. Holdco will then sell the mixed entity to divest Holdco. The tax analysis for the transfer of business unit A will be similar to what we just mentioned for option 1, just that it is now business unit A is being transferred. Gain from the transfer of the mixed entity by Holdco is generally subject to 10% EIT unless there is a relief under a double tax treaty. If divest Holdco is 100% owned by Holdco, tax deferral treatment may potentially be available. However, there are multiple conditions to fulfill, including that Holdco should not transfer the share of divest Holdco within 3 years after the transfer. If the transfer of the mixed entity is taxable, divest Holdco would obtain a step-up tax basis in the equity interest of the mixed entity, which can be deducted from any future transfer of the mixed entity. Just for completeness, if the mixed entity has accumulated tax losses, using option 2 will bring the tax losses with divest Holdco, which may result in more value to be brought to the group. Next slide, please. Option 3 could be viewed as a variance of option 2. The key difference between the two options is that in option 3, business unit A is carved out to a new entity through a split. From an EIT perspective, the split may possibly enjoy a tax deferral treatment. There are multiple conditions to fulfill, including that Holdco should not transfer the equity interest in NewCo within 12 months after the split. The transfer of the mixed entity itself within 12 months is not a problem. Having said so, if it would be a split of foreign invested company, FIE, as depicted on the diagram, there is an uncertainty around the interpretation of the China M&A tax rule as to whether it would be viewed as a cross-border transaction and therefore not qualify for the tax deferral treatment. Again, the local tax bureau practices vary from location to location. If it would be a split of domestic-owned entity, i.e., if the mixed entity is owned by another Chinese company, then there is a higher chance for the split to enjoy the tax deferral treatment. Note, in such a case, gain derived from the transfer of the mixed entity to divest Holdco may be subject to 25% EIT. Next slide, please. Apart from the China in-country restructuring we have just discussed, it is very important to note that the offshore level restructuring step could potentially trigger Chinese tax as well under the Chinese indirect share transfer rules. In our example, if the ultimate parent of the group transfer Holdco to divest Holdco, it will be a typical Chinese indirect share transfer transaction. If Holdco is an SPV and only owns the equity interest of the mixed entity, the transfer may be deemed as a direct transfer of the mixed entity. In such a case, any gain arising from the transfer that is attributed to the mixed entity will be subject to 10% Chinese enterprise income tax. If the ultimate parents transfer Holdco to divest Holdco in exchange for divest Holdco shares and some other conditions are met, the transfer may fall under the safe harbor rules under the Chinese indirect transfer rule and therefore not be taxable in China. If the ultimate parent subsequently transfer divest Holdco to a third party, it will also be a Chinese indirect share transfer. Whether or not such a transfer will be taxable in China needs to be further analyzed based on the specific facts and circumstances. So as you can see, the carve-out restructuring step could involve quite some complexity from a Chinese tax perspective. Before a restructuring plan is finalized, different options should be evaluated with a combination of commercial and tax considerations. Thank you.
Okay.
Back to you, Chair.
Indeed, it's very complicated. Yeah. So Ken, now can you tell us about Hong Kong tax environment or M&A activity?
Sure, Kelly. Hello, everyone. My name is Ken Poon. In the next coming 10 minutes, we'll talk about some of the offensive and defensive M&A tax strategies that are seen in the market. Okay. First of all, under the current environment, many corporations are actually evaluating their business strategies as well as take this opportunity to streamline and reposition their portfolios. Like monetizing capital-intensive assets, for example, real estate to REITs and funds may be one of the options. Some companies may even consider to carry out such type of restructuring together with financial investors in order to provide sufficient funding and improve the overall profile of the resulting structure. But despite that, the Hong Kong tax system is relatively simple, and it does not impose any turnover tax like VAT and GST. Capping out of capital assets may potentially lead to certain tax costs or cash tax impact in Hong Kong. The capping out of capital-intensive assets may be carried out through an asset deal. For example, that is direct acquisition of assets, or a share deal, that is acquisition of the holding company of the assets, which would give rise to very different tax implications. In addition, Hong Kong imposes stamp duty. For Hong Kong stamp duty purposes, under an asset deal, transfer of immovable properties located in Hong Kong would subject to Hong Kong stamp duty at a rate up to 4.25% on the hire of consideration or fair market value of immovable properties. For residential property, stamp duty of 15% applies for a person other than Hong Kong permanent residents. In addition, like buyer stamp duty and special stamp duty may also apply if certain conditions are met. So on the other hand, under a share deal, transfer of Hong Kong companies would be subject to stamp duty at 0.2% on the hire of the consideration or fair market value of the shares. So as you can see, as compared to an asset deal, the stamp duty burden applicable to a share deal would be much lower. This is precisely one of the reasons it's more common to transfer the real estate under a share deal. In addition, intra-group relief is applicable for intra-group transfer of shares and assets if certain conditions are met. We typically call it Section 45 exemption. For Hong Kong profits tax, that is the corporate income tax in Hong Kong. Although Hong Kong does not tax on capital gains, under both asset deal or share deal, the gains on sale of shares or assets may be taxable at a rate of 16.5% if they are regarded as revenue in nature and onshore source. In addition, under an asset deal, depreciation allowances claims may be called back and taxed at the applicable rate, while under a share deal, if the sole or the dominant purpose of the transfer is to utilize the tax losses of the company being acquired, anti-avoidance provisions may kick in to disallow the utilization of tax losses on a going forward basis. Other than Hong Kong tax implications, if the Hong Kong shareholder is holding certain capital-intensive assets outside Hong Kong, under both asset deal or share deal, there may be potential overseas tax implications. For example, like Simon mentioned about, capital gain tax under the indirect transfer rules in mainland of China.
Okay.
Next slide, please.
It's very interesting. Yeah. Maybe you can illustrate your point with an example to help our audience visualize such an operation.
Sure thing. Yes, Kelly. Let's take a look at this example. Under this case, the shareholder is going to carve out the land and building in Hong Kong and put them into a REIT or fund structure set up with which is co-investors in order to monetize it. In theory, the shareholder can choose to transfer the Hong Kong company to the new structure or to transfer the land and building directly to the new structure. Under both scenarios, the seller should consider the potential tax implications on gain on disposal. Like if the holding period is relatively short and shareholders has profit-seeking motive at the time of acquisition, such gain may be regarded as revenue in nature. If, on the other hand, if it is considered as onshore in nature, such gain will be subject to Hong Kong profits tax at a rate of 16.5%. On the other hand, tax exemption may be applicable on the transaction if gains are considered as capital in nature. In addition, at the time of transfer of the company that holds the properties, there is a chance that the Hong Kong RLD, that's the tax authority in Hong Kong, may regard the intention of holding of assets change from capital to trading at that point of time, which may affect taxability on future gains on disposal. So therefore, it would be crucial for the buyer to clearly document the intention of holding of assets at the time of transfer. Furthermore, under an intragroup transfer, the transfer may be carried out at cost, notwithstanding that in the past, the Hong Kong RLD may accept transfer of assets at cost for intragroup transfer in certain circumstances. But under the new transfer pricing rules enacted in 2018, the RLD may adjust the transfer value to fair market value if the transaction confers a Hong Kong tax advantage. In case the value of such assets has increased significantly, this may potentially trigger cash tax impact in Hong Kong if the gain is considered as revenue nature and onshore source. For Hong Kong stamp duty, it will be calculated based on fair market value under both share and asset transfers. Under share transfer scenario, the applicable stamp duty would be much lower, as mentioned before, as compared to an asset transfer. Hong Kong land and building may be held by an offshore company, provided that the share register is not kept in Hong Kong. The transfer of that offshore company would not be liable to any Hong Kong stamp duty. Also, under an asset transfer, commercial building allowance or depreciation allowances claimed by the Hong Kong company in the past may be clawed back. Even though the commercial building allowance or depreciation allowances may still be claimed by the new buyer, cash tax impacts may be triggered. On the other hand, under a REIT structure in Hong Kong, an authorized REIT is exempt from Hong Kong profits tax, but the rental income from real estate in Hong Kong held by REIT directly is subject to Hong Kong property tax at 15%. Based on the net assessable value. In case the REIT holds real estate in Hong Kong through SPVs, for example, under share transfer here, the SPV is subject to Hong Kong profits tax at 16.5% for the profits derived from the real estate. So if we can move to the next slide, please. Some investors are taking a more positive view on the market outlook and taking this opportunity to acquire undervalued real estate in Hong Kong. One of the most common issues of real estate acquisition in Hong Kong is the potential non-deductibility of interest expense. In Hong Kong, expenses are only deductible to the extent that it is incurred in the production of assessable profits. So if the shareholder borrows from a bank and then on lends to BICO for paying the purchase consideration, the interest expense incurred by the shareholder should unlikely be deductible as the shareholder does not receive any taxable income. It is because dividend income to be received by the shareholder should generally be not taxable in Hong Kong. So refinancing the debt at operating level may be carried out to work for potential interest reduction, we call it a debt push-down strategy. In such strategy, under post-acquisition financing, buyer can set up NewCo, which is usually a wholly owned subsidiary of BigCo. With the loan obtained from bank, NewCo uses the fund to acquire the property and the related business operations. With the consideration received from NewCo, HoldCo will then distribute dividend to BigCo to repay the shareholder loan. Then the shareholder can use the proceeds from the loan repayment to repay the bank loan. Under this situation, interest incurred by a NewCo on the loan obtained from bank is generally deductible to the extent that it is used for the production of accessible profits, for example, lease income. As this post-acquisition refinancing involves transfer of land and building from HoldCo to NewCo, stamp duty will apply. Nevertheless, intra-group stamp duty relief may be applied if certain conditions are fulfilled. However, in case the shareholding of NewCo change within 2 years after the transfer, stamp duty relief would be clawed back. So, in addition, since an asset transfer will be carried out by HoldCo, in case the land and building is not considered to be long-term investment of the HoldCo, potential Hong Kong profit tax implications may apply on gain on disposal. Moreover, if the sole or the dominant purpose of the transaction is to obtain tax benefits, that is the interest deduction, anti-avoidance rule may kick in and disallow the interest deduction. Therefore, taxpayers should handle the refinancing of debt very carefully. So that's all for MA tax strategy of Hong Kong for today. Thank you, and back to you, Charlie.
Sure. Thank you, Ken. Before we move to Taiwan, let's have our second polling question of the day. The question is, how do you think tax can add value in the success of MMA transaction? And you have option, number 1, identify significant risks in the tax due diligence process and develop mitigation measure. Second, identify value-adding proposition to the investment thesis. The third one, value creating in the post-deal integration process. Okay, next one, ongoing tax risk management. And the last one, don't know, not applicable. So while so audience, please make your choice now. So while we are waiting for the result to come in, it would be great if Simon, can you share your insight on the latest market practice in respect of a China Bulletin 7 in MMA context? Simon? Simon, are you online?
Sorry, thank you. Bulletin 7 mainly deal with indirect share transfer. Although Bulletin 7 provides that reporting is optional, if tax is payable but not paid, buyer will not obtain a tax basis step up and you may potentially be subject to non-withholding penalty. In view of this, it is common for buyer to require seller to report the transaction with the Chinese Tax Bureau and provide a confirmation that such reporting has indeed been done. Joint buyer and seller reporting is also increasingly seen as this will protect buyer from a non-tax withholding financial penalty risk.
Okay.
Cherry, over to you.
Thank you, Simon. Okay, sure. Simon, thank you, Simon. Now let's look at the number here. Okay. I think, yeah, indeed, I think in most of the cases, because right now we got the most number, actually we got 45%, our audience consider that actually the tax can add value during the tax diligence process and develop the mitigation measure. But of course, on the other hand, because with all those findings, people also see the value because the second highest number we have is the ongoing tax risk management. Yeah, I think that's all for our polling question. Okay, if we may, now let's move to Taiwan. Despite that Taiwanese government has managed the spread of COVID-19 quite well, certain sectors and many Taiwanese companies still have been impacted, and they are exploring the M&A opportunity either to safeguard core market or try to maintain competitiveness through a carve-out of the distressed business or just to monetize its assets. When it comes to divest the assets of business, it's crucial to understand the different approaches. In Taiwan, the most commonly used are business transfer and spin-offs. A business transfer is relatively straightforward and normally will not require the regular approval. But if such transfer will reach the threshold of the antitrust law in Taiwan, that is, we call it fair trade law, for example, the acquisition reached 1/3 of market share, then the approval will be required for such purpose. Also, the disposal of substantial acquisition disposal of the company assets will require the board and shareholders meetings approval as well. In practice, the business transfer may involve the employee transfer, so another issue is that there could be the cost of severance pay to the employee who are unwilling to move. But overall, this approach is convenient and straightforward. On the other hand, a spin-off followed by a share transfer could be taken into consideration as other alternative to the business transfer. Comparing to business transfer, spin-off normally could be more tax-efficient option. Also, as a buyer normally will buy the new company after spin-off, the historical liability and legacy issue may be mitigated. But remember that under the Taiwan MMA Act, there is a clause which will be required a new company to jointly liable for the liability associated with the business and asset transfer for 2 years. So the buyer need to bear in mind. Also, depending on the business need and complexity of the shareholder profile, the spin-off basically could be done either through vertical spin-off and horizontal spin-off, or we can call them parent and subsidiary type of spin-off or brother sister type of spin-off. A vertical spin-off is more clean-cut and will not involve the shareholder. That is, it simply contributes its asset and liability into an existing or newly incorporated company in exchange for a new share issue. However, there will be a capital gain tax when the spun-off company disposes the newly spin-off company. The capital gain will be subject to alternative minimum tax, we call it AMT, at 12% or 6% if the transfer is deferred after 3 years. On the other hand, the brother and sister type of spin-off could be used when the seller has relatively simple shareholder structure. Such type of spin-off is especially popular to the individual shareholder or seller. This is because after the spin-off, the individual shareholder could sell its share free from income tax. But now the situation will be changed. Starting from 2021, we have new tax proposal to impose a capital gain tax on the gain derived by the Taiwanese individual through the disposal of private company stock. So now we have quite a few restructuring projects prior to the MMA transaction, which need to be done before the end of 2020 to save the capital gain tax. Next slide, please. Now, I would like to highlight the key tax difference between the two approaches from Taiwan tax standpoint. In general, any gain arising from the transfer assets of business will be subject to corporate income tax. Also, various transaction tax, such as VAT, D-tax, and security transaction tax, or real estate tax, if any, will be triggered depending on the nature of the asset to be transferred. However, the Taiwan MMA Act provides tax relief for both approaches under certain conditions. In a business transfer scenario, the buyer will be able to use the step-up basis following the purchase price in order to claim for tax deduction and will not assume the historical tax liability from the seller. Normally, the tax cost for the seller will be heavier under this approach. Nevertheless, the VAT and other transaction tax can be relieved if 65% of the total consideration is paid through the issuance of new share by the buyer. Also, it is possible that income tax could be exempt if 80% of consideration is paid through the new share issuance and passed over to the seller shareholder. But of course, holding structure could be twisted accordingly. Similarly, under the case of spin-off, the foregoing VAT transaction tax could also be relieved under the M&A Act as well. From income tax perspective, in general, the spin-off is an internal reorganization, and thus the net book value will be used. So the income tax impact could be managed. Even if there is any income, it may be triggered again if 80% of consideration is made through the new share issuance and passed over to a shareholder, could also help to exempt from income tax as well. The example would be the brother and sister type of spin-off. On top of the tax exemption, there are other tax considerations I would like to share with our audience. Another consideration would be regarding deemed dividend in a horizontal spin-off. Though CIT exemption apply, shareholder of the transferring company can have deemed dividend in a horizontal spin-off to the extent that return earnings are reduced. In sum, the buyer usually prefer business transfer rather than spin-off to enjoy higher tax basis and mitigate tax risk, while sellers usually prefer to carve out assets or business using spin-off to minimize their tax costs. Next slide, please. Okay, then next, I would like to address the topic of pursuing co-investment in Taiwan by taking example of the green energy industry, which has been one of the most attractive sectors for recent years. This is due to the government's ambition to phase out the nuclear power plant by 2025. This slide provides a commonly used investment structure by foreign investors. Typically, foreign investors use an offshore SPV. It could be situated in a country having a tax treaty with Taiwan. They will incorporate an onshore SPV through equity and debt. That onshore SPV will then use the inject fund in order to acquire the share in the project company that actually operate wind farm or solar project from the seller. Under this particular holding structure, withholding tax on cross-border payments such as dividends, interest could be reduced if tax treaty applies. Onshore SPV could also serve as not only a joint venture platform for local partner, but also local financing vehicle. Okay, let's move to the next slide, please. What we have listed here are must-know tax topics for investment projects in the green energy industry at different stages. During the life of a green energy project, especially the wind farm project, the cash repatriation strategy is important since the pre-operation stage is quite long and the income generating will be prolonged as well. Therefore, to move the cash outward through the dividend, interest, and capital reduction can be considered. But normally the capital reduction at the project company level is difficult. As for financing arrangement, it is important to keep in mind about the interest payment deductibility, transfer pricing, compliance, and sink cap rule. One cash planning strategy is about the VAT reclaim of the fixed assets. Normally, the input VAT could only be credited against the output VAT. The fixed asset VAT reclaim is an exception. Also, the timing of recognizing the fixed assets could also impact timing of the tax depreciation and tax losses incurred, which are also important when reviewing the financial model. Furthermore, though we indicate the income tax holiday here for infrastructure projects, but in practice, this income tax holiday is not available for wind farm and solar projects. This is because Taiwanese government believe that they have granted sufficient award, such as preferential feed-in tariff, to this business. In a nutshell, with regarding the complexity and the diversity of tax issues involved in such projects, we will suggest the audience to seek out our tax advisor before jumping to conclusion. Okay, now let's move to the last slide, please. Lastly, I would like to mention two tax-related amendments to the Taiwan MMA Act, which are now in the public consultation process. The first amendment could, to a certain extent, prevent acquirers from suffering tax leakage due to the narrow definition of intangible asset in the Income Tax Act, which is limited to trademark, copyright, patent, and other franchise. The amendment will allow payment for trade secrets, client relationship, and software, which are commonly acquired items in MMA deal, to be amortized for tax purpose. Such intangible could be amortized over the remaining service life of the intangible acquired, or 10 years. With regard to the Second Amendment, it is to increase the individual seller's willingness to sell the startup company as a result of a merger or spin-off. The amendment would provide a 5-year tax deferral for individual seller. However, there is also a clawback clause if the share received through the merger or spin-off are further transferred to others within the 5-year period. To sum everything up, the main purpose of these two amendments is to remove the long-run obstacle to MMA deal and create a more deal-friendly environment to invest in Taiwan. Okay, this will bring us to the end of our today's discussion. I would like to thank Stanley, Simon, and Ken for their input. But I think we do have some time to respond to some questions from our audience. Okay, I got one Hong Kong question. So Ken, there's one question. How to determine capital nature and revenue nature income is a common question, right? Is there any holding period specified by the Hong Kong IRD in order to be categorized as income or capital in nature?
Okay, thank you. The Hong Kong IRD did not specify the holding period if the asset in order for the income to be regarded as capital in nature. In distinguishing whether a gain is capital or revenue in nature, the Hong Kong IRD would usually consider all relevant circumstances and documentations pertaining to the case. In general, reference is often made to the so-called 6 batches of trade, which sets out a certain criteria in determining whether an asset is of a capital nature or revenue nature. The 6 batches of trade includes length of ownership, taxpayers' motive, any similar transaction, and etc. None of the factors above can by itself provide conclusive evidence of whether an asset is capital or revenue in nature. All of the factors must be considered in totality before a final decision can be reached. Thank you.
Okay. Thank you, Ken. Now we have one China question here. So Simon, there's one question regarding goodwill. Is goodwill amortized for tax purpose in China? If not, how to obtain the tax normalization for identifiable intangible for the entity which acquired the business from the mixed entity? Simon?
Thank you. Okay. Goodwill is not amortizable for EIT purposes in China. It is generally not straightforward to take tax amortization for other identifiable intangible. Usually the valuation of the identified intangible needs to be supported by third-party valuation exercise. And the separation of the intangible asset needs to be recognized for accounting purposes. In addition, sometimes the book value of the assets may not be stepped up to the transaction value in an intra-group restructuring. In such a case, the tax amortization of identifiable intangible will result in a book-to-tax adjustment and therefore subject to closer scrutiny by the Chinese tax authority. Sherry, over to you. Thank you.
Okay. Then there's one Taiwan question. It's about any criteria to be met for statutory spin-off. Okay. First, the business to be spun off must be in an independently operated business, normally a BU or operational unit would be sufficient. In practice, transfer of back office unit having no revenue generating will not be qualified as independently operated business. Also, the consideration of spin-off can be cash, share, or other assets. However, only the consideration made through the share issuance will have the chance to be qualified for the tax exemption. Okay, unfortunately, that's all the time we have. Stanley, Ken, Simon, thank you so much, and special thanks to all of you who were able to join us. We would like to encourage you to fill the short survey. They will pop up on your screen momentarily and tell us what you think about today's program. If you join us late, please know that this presentation will be archived for future viewing. If you feel that others will benefit from the webcast, please share the webcast through the share list icon and have them visit the Debrief website. We will respond to all the questions submitted during the webcast in a couple of weeks. Also, if you think of any other question or comment later, please feel free to reach out either to me or our speaker. We'll be more than happy to talk to you. And please do not forget to tune in our next scheduled webcast from the Indirect Tax Series on December 10, titled Overview of China Export Control Law and its Implication. At last, from all of us at Deloitte, thank you for your participation in Deloitte Asia Pacific Tax Webcast today. Goodbye.